Good afternoon, everyone. I'm Jennifer DeCamp with sbLiftOff. It's my pleasure to welcome you to our live webinar, GovCon M&A Fast Forward. sbLiftOff is not your typical M&A firm. Founded and owned by women, we have a strong focus in GovCon, and we serve the mid-market with our mission to secure the enduring value of business owners. Let me introduce our panel. Our first speaker is the founder and CEO of sbLiftOff, Sharon Heaton. Sharon has advised on transactions totaling more than $12 billion in deal value and is passionate about bringing high quality to mid-market owners. Sharon has a law degree from the University of Chicago Law School, a BA from Barnard College at Columbia University, and has been associated with the global law firms Skadden Arps and Lathan and Watkins. Next, Jonathan Wolcott. Jonathan is a partner in the corporate and M&A group of Holland and Knight. He has represented numerous government contractors in M&A, public and private securities compliance, and related transactional matters for over 18 years, as well as representing private equity firms and investment banks working in GovCon. Now, over the next hour, you can submit questions throughout the presentation in the Q&A section at the bottom of your screen, and the panel will answer your questions at the end. Okay, so let's get started. GovCon Fast Forward. Sharon, what's ahead for GovCon, and what can you tell us about the market now and into 2021?
Well, thank you, Jennifer. It's a pleasure to be here, and Jonathan, it's wonderful to be here with you. As some people in the audience may have learned, there's a presidential election going on, and I think that election's about to culminate in about a week from now. So for GovCon, the question becomes, what is the impact of that presidential election on GovCon? And I think that I can generally say that for the most part, it's minimal. There's definitely some impact, and we'll talk about that more as we go forward. But the basic blocking and tackling of when is the right time to sell your company or the right time to buy a company has not fundamentally changed. You need to be looking at two different factors. One, what's going on in the macroeconomic environment, which is like interest rates and the availability of capital and things like that. And all of that looks pretty darn good right now. And then the micro, whether or not it's a good time for your company. The fact that there's going to be a presidential election does not necessarily change interest rates, nor does it change the availability of capital. We do likely think that there's going to be some changes in tax policy if there's a change of administrations, and that could have an impact on the timing of when you want to bring your company to sale. But I don't think that there'll be tax changes necessarily if the present administration continues. So there are a number of things that we should talk about, and we will during this time period. But right now is a very strong time in the market generally to go and sell your company or to buy a company. It is still unclear whether or not it works for your company. Important consideration. Jonathan?
Thanks very much, Sharon, and I really appreciate your and sbLiftOff's providing the opportunity for me to join you today and to talk about these interesting and important topics. Sharon, I think I'd echo what Sharon says about the market today, and just to give a little bit more color on what we're seeing in the market today. And those of you that know Holland and Knight know this already, but for those of you that aren't familiar with us, we are one of the market leaders in government contracting M&A. We tend to do about 30 or so closed deals a year, which is a significant portion of the deals in the space, particularly focused on the middle market. So to some extent, what we're seeing in the market is a harbinger of what is actually happening. And we saw what a lot of people know and have seen, which is that there was great activity in the first quarter of this year. And then with the pandemic hitting, it really tailed off. Although processes in the GovCon arena did not stop. After the sort of initial uncertainty about COVID and people confirming that contracts were going to move ahead and be performed upon, I think people had some confidence that after a little while things would come back, and they have come back with a vengeance, I would say. The Q3 deals were up to sort of maybe the same period activity of last year. And right now, it's hard to say how many closed deals will be in Q4, but we are as busy with active deals as we've ever been. So clearly the market is sending signals that there's a lot of buyer interest out there. The macro factors are still very good right now, as Sharon mentioned, low interest rates, lots of dry powder on the side of buyers. It's a very, very active time. What's going to happen is of course much harder to predict, and neither Sharon nor I are political pundits or prognosticators or any of that. So we disclaim. We might put my lawyer hat on. Anything that we predict here. But clearly, some things will probably change, particularly with the Biden administration, and we'll talk about that in a little bit.
I want to echo what Jonathan just said. Jonathan Holland and Knight is one of the leading M&A law firms. sbLiftOff has been very active in the GovCon space in 2020. So when the virus started to hit and we all began nervous, and we continued GovCon deals. Basically, in January of 2019, being in GovCon maybe wasn't such a great thing when the government shut down. However, in 2020, when the virus hit, it was a terrible time to be a restaurant or a nail salon or a retail store. But it actually was a pretty good time to be in GovCon. We have a number of clients that are hitting their highest quarterly revenue numbers ever in this year. So I think that Jonathan's right. There was a bit of a hiccup. We didn't start new processes in March or April, but we did finish off processes. And then certainly by June, July, August, things picked up again. So we found that there was a bit of a dip in the GovCon market where people kind of held back for a matter of a couple of months to figure out what was going on. But once they got their sense of stability and realized that the world was not ending and the government was continuing to need all the services that it needed before, those deals have started off moving very actively. And I do agree with Jonathan that it will make a difference as to who wins in two basic areas. One is tax policy. I think that we should assume that there will be higher capital gains rates under a Biden administration. Now, the important element of that is higher capital gains rates don't kick in the day that he's elected. They don't even kick in the day that he's inaugurated. Congress needs to go through a process for doing that. So it's highly possible that those tax increases would not come in until the second quarter or even later in 2021. So if you're thinking about selling, there's a real reason to try and do it now, because it's not just the purchase price that matters, it's the amount that you put in your pocket. And that makes a big difference. The other second major change, I think, because of the presidential administration, could be funding priorities. Clearly, under the existing administration, being involved in the Department of Defense or the intelligence community or DHS, very important, lots of funding available. But if you were in, let's say, the EPA or USAID, maybe there was some more cutbacks. I would expect that if, in fact, Joe Biden were elected, we're more likely to see more activity on infrastructure issues, clean water, clean energy, and other related, maybe international issues as well. So I think that you do need to be looking a little bit as to where will the pockets of money be, and as a GovCon contractor, how can you access those pockets of funding?
Fully agree with that. And on the tax side, clearly what a seller would pocket is a major consideration to a seller. But harkening back to what Sharon said, the right time to sell is the right time for you, and not necessarily what the overall tax or market implications are. I think we'll talk about that a little bit. But on the tax side, clearly under the Biden administration, a seller would see hits in what they would take on an apples to apples now versus under Biden plan analysis. But and then there's another factor too that companies should consider under Biden's plan, and one key there and under Biden's plan is whether or not the Democrats would take the Senate. It appears that is a more likely proposition than it was probably a couple months ago. But if the Senate still stays in the Republicans' hands, it may be a lot harder to get the full plan or the full rates that are being proposed through. But the other factor that's in the Biden proposal that is of interest to owners of businesses and managers is the corporate tax rate would also go up. And some people talk about this double-edged sword if you're thinking about selling your company, that not only would your take home from the sale go down because of capital gains and other personal income tax changes, but corporate taxes are going to go down, are going to go up, excuse me. And so valuations and your cash flow multiples might decrease or be depressed as a result of that. It's a consideration. It's not necessarily a done deal, but it is a one factor to consider in all of this. And as Sharon mentioned, budgetary considerations are clearly a factor for a company. Being aligned with the right priorities, and it really should be tomorrow's priorities, not today's or yesterday's priorities for the government, is crucial. And so, one of the things that the Biden administration has indicated, they may not cut defense, but clearly they're going to take a look at legacy systems, and they're going to look at new technologies, AI, cyber, drones, all the things we've been talking about in the government space for years and years, but may see some acceleration under a prioritization in the Defense Department. And then in the civilian and other agencies, there's clearly going to be an emphasis in the Biden administration on clean energy, healthcare. Even within the Department of Defense, healthcare and retirement benefits make up a huge portion of the spend there. And I think people will probably take a look at that as well in the future, maybe regardless of who wins the election. So several factors on a macro basis, but those should always, of course, be considered in conjunction with what's happening to your actual business and what you want to get out of a deal.
That's an excellent point, Jonathan. And we've touched on this a couple of times, but I really want to dig a little bit deeper into it, which is there's two factors that you need to be looking at when it's time for you to sell your company or even to buy a company. One is the macro environment that we've been talking about, taxes and where spending is going to be and interest rates and all of that. To be honest with you, issues that we don't control as individuals, but maybe we do as a society. But here's what we do control, the micro, what's going on in your company. Because a GovCon company is largely a portfolio of its individual contracts. And if you've just won contracts and you've got 5 years of, an option year, four option years ahead of you, that's a pretty terrific time to go to market. On the other hand, if in fact you are towards the end and you're going to have to do some recompetes, let's say in 2021, it's going to be more of a challenge. So you really need to figure out the right timing, not only for the macro, but for the micro. And that's where I think Jonathan and I spend a lot of time counseling our clients as to, is this a good time for you particularly to go to market? I'm working with one company right now. It's a fantastic company, and they're making lots and lots of money, and they've got great relationships with customers, and they are hitting on all cylinders. They have 2 recompetes coming up in 2021. They're very convinced they're going to win these. So what I've suggested to them is that we basically put this process on hold until those recompetes go forward. Now, we have had circumstances where owners have turned to me and said, Sharon, I'm on my last nerve ending. I can't do this anymore. Or I have an illness and something is requiring me to sell right now. You can always sell your company. The question is, will you be able to get a fair price for what it is you've built? And timing can make some real difference on that. The company I was just mentioning, fantastic company, they would not do as well if I brought them to market in November, December, than if I wait until those weeks happen in March or April. The world is not going to change, at least, to the extent that I can foresee it, in that time period, but it will make a big difference on a micro level. So those are the kinds of considerations that Jonathan and I talk about with our clients, because just because you're ready doesn't mean that today is the day that we should start. It may be that we should have started 6 months ago, but it may also be that we want to get the process started and then figure out the exact right time for you to maximize the value of that transfer.
Absolutely. And I two very important points that Sharon raises there. One is the personal side of a sale process. As a business owner, especially of one that's a closely held business or a few partners that have built a business up over a period of time, the desires and the needs and the goals of those individuals are really important in this process. those who haven't been through a sale process may not fully understand how stressful, how all-encompassing it really is. And so, therefore, you don't want to do it 3 or 4 times to try to sell your company over a period of years. It's very taxing, and we've had clients that have done that. And we talk about deal fatigue and all these other sort of intangible factors, but they do enter into the thought process. And so when I sit down with a client that's thinking about a sale, I don't sit down and start to talk about, oh, let's get the best indemnity terms from the get-go, or Sharon said, I say, what do you want? What are your goals? And that results in some very interesting conversations that are very informative as things move forward. And so, owners really have to have those in mind when they enter into this process, because it's not an easy process. The second thing is on the micro level, de-risking your business before a sales process is the most important part. Like any other business propositions, a sale process is a series of risk propositions. And there's valuation risk, there's legal risk, there is personnel risk, there's all sorts of risk, contractual risk, customer risk, competitive risk, all of those things. The best time to sell is when all of those things are, presumably aligned in a fairly low risk pattern. And so that is really the best time to sell. Obviously, the macro issues do weigh into that, but rushing a sale or waiting for a sale too long because you think certain things are going to happen may not be in your interests. The clear thing that one needs to do, an owner needs to do in considering a sale process, is consider all those factors and consider them together. So sitting down with good advisors like Sharon and walking through all those factors and really doing kind of an analysis of the trade-offs that you might have to make in a transaction process.
Jonathan's making an excellent point. And he's right that risk is, clearly something that has to be mitigated. It's a very personal process. Most of the people that we work with have been raising their companies as long as they've been raising their children. They've been working on their company 5 years, 10 years, 15 years, sometimes 20 and 30 years. And they've come to look at their company as though it is almost a baby that they have been nurturing for all of these years. Being able to distance from it in some way is part of the process. Being able to look at the company as though a third party will look at it. But it's also important that you find a third party that shares your values. There are 2 things that I wanted to specifically say. One is Jonathan made reference to the corporate tax rate going up. And he's right, but that's for C Corps. And most of the companies that we deal with are either S Corps or LLCs. Some of them are C Corps. Now, it's very possible that the personal tax rates will go up by a couple of percentage points as well, but it won't be the kind of change that there would be on the C Corp, where it went all the way down to about 21 from, I think, 36, and now it's going back up to possibly 28, again, depending upon the results of the election. The second is when we're talking with people about selling their companies, very rare is the business owner who says, at the end of the day, the most important thing to me is the amount of money I get. When I start with a client and I say, what do you care about? It's always the purchase price. We want to maximize purchase price. Completely understand, completely agree. You've worked hard, you deserve that. And then I ask questions like, well, what about the employees? And inevitably, people come back and say, oh my God, my employees, they've been with me for a long time. I really care to make sure that they continue to have jobs. They've been with me for 10 years. They need to be treated fairly. And I say, well, okay, so tell me about your customers. What kind of quality of work do you provide? How important is that to you? And everyone comes back with, we're really conscious about providing really good services to our clients, and we want to make sure that that continues. So I then take a step back and say, okay, so we've got price, and price matters, but so do your employees, and so do your customers. What we need to do is find somebody who meets the same value set that you have in running your company, so that the people who work there, the people who receive services from it, can continue unabated. We view these processes as the company being an extraordinarily valuable baton. And somebody's been running a race with that baton for decades, potentially. And now it's time to transfer it to somebody else. And we need to make sure that it's going to be a buyer who respects that baton and the people and the services just as much as you have. And so money is important, but certainly not the only factor that matters for many of our owners.
On related to that topic too, keeping your purchase price is in a deal, and thinking about how you may do that is important. And there are several ways to do that. Up front, in terms of preparing for a sale, I'm talking about de-risking your sale process, and then when it finally closes, keeping the money that you actually are supposed to get in the deal as a seller is very important. For those who haven't seen a purchase agreement for a deal, it's 60 to 100 pages long, and there's about 5 or 6 pages about what the seller gets, and then there's about 90 pages about how the buyer can get it back, to be quite honest. And when we're representing the sellers, obviously we try to mitigate that risk, but that's the reality of a business deal, an M&A transaction. And the ways to de-risk that part of it are to prepare for a sale. That's the best thing you can do. Not necessarily to embark on a sale without having prepared your company for it from several perspectives. One is obviously, ensuring the valuation will hold up during a sale process and afterwards. But there are other factors too, in terms of having the right management team in place, having good business development that will continue beyond perhaps a seller owner who has had forward-facing relationships with the customers. Getting rid of, it's Halloween time, getting rid of the skeletons in the closet. I have a saying that I tell my sell side clients, that it is 2 to 3 times more difficult, meaning 2 to 3 times as expensive, and takes 2 to 3 times longer to fix a problem that may exist, whether it be some investigation, whether it may be some lingering tax issue, whether it may be some compliance type issues, all those kinds of things, whether it may be some latent employee issues. It takes longer and costs a lot more to fix those with a buyer looking over your shoulder than it would to do 6 months in advance of going out to a sale. So, preparing for the de-risking is a very important part of all of that process.
I think that what Jonathan's saying is absolutely right. The trick is to let the perfect be the enemy of the good. I have seen a company that has only no challenges. Every company has challenges. What we believe at sbLiftOff is that there needs to be a partnership between us and our client, and ultimately between the seller and the buyer. While the seller is nervous during this process, and I understand that, they've been working on a company for a long time, this is a major personal financial transaction, there's a lot at stake for the seller. The buyer's even more nervous. The buyer is the one who will, as much due diligence as they do, the buyer will never know as much about that company as the seller does. So the buyer is looking for any kind of indications that you're trying to hide things, or that you are not disclosing what it otherwise be disclosed. So we spend a long time working on transparency. We understand every company has challenges, and it's so much better, along with what Jonathan is saying, for us to find them and fix them, or to acknowledge them, than it is to basically try and sweep it under the rug. The likelihood of you able to sweep it under the rug and successfully close a deal is very small. But even if you did, that doesn't mean that the world ends upon the transaction closing. There is a fairly lengthy legal document. So it is much better to get a valid price for your company at the LOI stage, because there's been full disclosure between the parties, things, and have it come up during the process of due diligence afterwards. And this kind of goes to one of the issues that Jonathan and I have touched on, which is valuation. Occasionally people will hear about EBITDA, and you have to wonder, what is this EBITDA you speak of? What does that even mean? Well, EBITDA is a term it's an accounting term, earnings before interest, taxes, depreciation, amortization. And there is a slide that you're looking at right now, which is kind of a slide that shows the kind of factors that people take a look at when they're evaluating a company. If you're a company that's primarily got subcontracts and you're an 8A, then chances are you're not going to get a tremendous valuation. You're going to get it more towards the left side of this screen. If, however, you've got a facilities clearance and you've got prime contracts, you've got cleared employees, you're doing some, substantive work as opposed to kind of lower skill stuff, you're more likely to get to that 5, 6 range. It's hard for companies with designations, whether it be service disabled, women owned, et cetera, to get above about a 6 or so, give or take a little bit. But you can, and certainly the more full and open you have, the more likely you are to get to the right side of that screen. So those are just some factors to be keeping in mind. Contracts that are prime versus sub, the kind of work that you're doing, whether or not there's clearances, what agencies you're working for, what kind of CPARs and past performances do you have. So this is kind of a guide as to where the GovCon market is. And what about the GovCon market is that in 2018 and 19, while there were a lot of GovCon deals, valuations were going up, but still pretty much in this range. Whereas commercial valuations went flying way higher. In 2020, I think deals have come down a little bit, depending upon whether or not you've been affected by COVID. But in GovCon, they've been pretty stable. So it is just as attractive a time in terms of the value you'll get for your company in 2020 and 2021 than it was in 2019. And that's a good place to go. I can't tell you what those valuations will be towards the end of 2021 or 2022. If we could, I'd be at the racetrack, I guess. But I think that you just need to understand what the macro is and how to realistically value your company.
One other consideration too during this time period, and also thinking about aligning where your business is to what might fetch the best valuation is to really look at what your needs are in terms of aligning those to those value factors. And there are different mechanisms, and we're seeing a lot of companies, even smaller companies, take a look at their contract portfolio, their different business lines, and be a little bit more creative and take a little bit more maybe transactional risk. Obviously need to talk to your tax advisors about things like this, but we are seeing smaller and smaller businesses do spin-offs of certain businesses for different valuation purposes, in terms of, this business has these needs and another business may not be growing as fast and has different capital needs. We're seeing and have been seeing for several years a lot of people doing what we call contract or contract business acquisitions. So that is not the purchase or the sale of an entire business. Although under the FAR, you cannot just buy a naked contract. You can buy the business related to that contract. And you have to go through a novation process in order to affect that transaction. But we are seeing people out there looking to get into this contract vehicle, this IDIQ program, this GWAC, et cetera. And for some time now, there is sort of an active market in that. And those are two different options. There's several. And there's M&A on the buy side to increase your valuation factors, to be honest. And we are actually seeing a lot of smaller companies, maybe due to the fact that debt is at, continues to be and looks to be for a very long time at historically low levels, willing to go out and make acquisitions themselves. We're seeing small business companies that are about to emerge from their small business status go out and go on a little bit of a spending spree as they reach that ceiling for their small business program, because it doesn't really matter what their revenue would be in 2021 if they're going to blow through it anyway on their own, and go out and take a little bit of risk or go into some areas that they've been looking to get into, or expand their own business lines in certain areas to build up scale or other capabilities that they've been looking at for a long time. The M&A market that I spoke about doesn't just encompass control sales. It encompasses all of those things. But we are seeing right now lots of different kinds of strategies being used by companies to get their valuation or end goals, either their 5-year plan or their 1-year plan met to do that.
Very interesting. One of the things that I want to talk about is what are the kinds of things that kill deals? What are deal killers? Because whether it's an asset deal or a stock deal, whether you're only buying certain contracts or an entire company, there are certain universal truths. And the two things, in my view, that kill deals are, one, surprises. When either party finds out something that they weren't expecting, or they had an understanding of something different and they find out. So for instance, that's where the due diligence will come in. If a buyer finds out in due diligence that there's been some litigation or there's been a tax problem and they didn't know about that in advance, that could be a problem. So those kinds of surprises are very problematic. And that's where it's so important to be transparent and do due diligence and be fair and honest. The other thing that kills deals is time. As Jonathan said, doing deals is fairly stressful, and it takes a lot of top of mind thought. It's not something that you just kind of push aside while you're going through it. So you don't want to be in that process for longer than you need to, particularly if, as in most of our cases, we're maintaining strict confidentiality. It's very hard to be providing all sorts of information if you're not telling your employees that you're doing it. And the longer you're doing it, the more difficult it is to keep that process going. So having a process that is well planned and well executed is extremely important. I'll just say that's one of the reasons that we think that M&A advisors make such a difference, because a buyer, what we often have is a seller come to us and say, I just got an offer from my company. All I want you to do is help me sell it to that party. And of course, if that's what they want, that's what we'll do. But what we often say is, we'd like to take a step back. And before you do too much more with that party, we'd like to do our due diligence, because then we can help you identify the kinds of issues that will come up and to make whatever adjustments are necessary in the process. So the role of an M&A advisor is to coordinate the lawyers and the accountants and the tax people, and there's often due diligence on HR issues and on insurance, and coordinating all of that so that it moves swiftly and that people don't get bogged down, so that a 6-month process doesn't take 14 months, because that's when deals die. Jonathan, have you had any experience with that?
I have lots of experience with deal fatigue, and it is a deal killer. But to the end of what Sharon's saying, surprises, yes, surprises breach trust, and a deal is ultimately about trust between a buyer and a seller. We as lawyers can write all sorts of things on pieces of paper, but ultimately what it comes down to is a level of trust between the buyer and the seller that, before the deal gets signed, that the parties will actually, work together to reach a good deal and trust each other to keep that deal. I think actually one of the most important parts of a M&A process is the letter of intent. I think I have seen some buyers and sellers. I've seen some sellers enter into LOIs because they tend not to. Most of it's non-binding, too frivolously. I have a client right now that I'm working with that, a couple clients actually right now that I'm working with that, may have regretted what they actually signed up to in the LOI. And so really, having your advisors understanding what goes into those LOIs, and really getting an idea of these are going to be the terms of the transactions. You can't negotiate the full deal at the LOI stage, but having a good understanding of what will be the risk allocation terms, what will be the purchase price terms, and not just sort of leaving everything TBD down the line, results in a better process.
I strongly agree with that, Sharon, Jonathan. I strongly agree with that. And one of the things that sbLiftOff does, and I think that most places should do, I don't know if they all do, is we insist that the buyer do a reasonable amount of due diligence prior to signing that LOI. The seller knows what the company is, but a buyer who comes in and says, I love the confidential information memorandum. Give me an LOI, I'm going to sign it immediately. We will not sign an agreement with that party. We want them to know, as I said before, the strengths, but the challenges as well. So that when that buyer is going into the LOI is worth something. They know the company that they're talking about. And buyers that aren't willing to do that often turn out to be tire kickers. And it is a non-binding agreement, the LOI between the buyer and the seller, except for the fact that the seller is providing exclusivity to the buyer in most cases with an LOI. And that makes sense, it's fair, because the buyer is about to really turn on their lawyers and their accountants and all the rest of it. It gets very expensive for the buyer, and the buyer doesn't want to be in a competitive process post-LOI. Makes perfect sense. But they should have done enough work prior to signing that LOI that they really have a good understanding of the strengths and challenges of that company, so that what we're looking for is that the buyer can do whatever due diligence they want, but hopefully, if we've done our jobs right, it is confirmatory in nature. It's simply confirming all the things that we told them before. I tell my sellers, due diligence is going to be intrusive, and by the end of the process, the buyer is going to know the color of your underwear. Don't think that you're going to be keeping anything from the buyer. You're not going to disclose. On the other hand, we want to make sure that we know all the things that are there for them to find, and we've told them about it. Now, I think I'd like to see if there's any questions that we might have from the audience.
Yeah, we do have some questions, Sharon. Thank you, Jonathan and Sharon. The first question we have is, can you speak a little further about other tax implications that might be ahead given the results of the election? You've mentioned that relative to taxes, this might be the best time. If one misses this window, what other planning can mitigate tax implications of a transfer?
I'll probably ask Jonathan to speak to that in greater depth. There is some tax planning prior to bringing your company to market. Some of them are fairly complicated, like setting up trusts and some LLC arrangements. There are people who are very involved in doing that. What I have found, interestingly enough, is that people who are selling 20 and 30 and 40 and $50 million companies, is some of them are basically saying to me, Sharon, I just want to pay my taxes and move on. I want to know how much money is actually mine. Now, there are definitely tax preferred opportunities, but they are complicated, and you'd really have to be engaged in that. Jonathan, you probably know more about that than I do.
I'm not a tax lawyer, and obviously it depends on your individual tax situation and what your company and their corporate tax situation. But yes, as Sharon mentioned, in advance of a sale, there are some estate planning techniques that can be used, and those often are best done when there is a lower valuation. You cannot take advantage of those when you have a valuation, an indication of interest or a letter of intent from a buyer. So that would be a significant consideration for sellers at any level. But given perhaps some depression on valuations as a result of what's coming on right now, it's unclear. I'm not going to tell you there's depressions in valuation, but we'll see. But this might be a good time to consider some of those if you're not going to go out to sale, to sit down with your tax advisors and consider locking in a lower valuation from an estate planning perspective. And there are some techniques that can be used for those.
I had a client earlier this year, veteran owned, started a company, grew it over a period of years, and we were able to sell it at a very nice valuation. And he was a C Corp. And as I mentioned before, many of our companies are S Corps or LLCs, but he was a C Corp. And he was very proud of being a C Corp because that's what the big guys are. That's what the publicly traded companies are. And so he told me all the wonders about being a C Corp, and I said, okay. We went into a letter of intent, and he said, what can I do now to minimize my taxes? And I said, you can't now, because we've signed a letter of intent, so your value is pretty much set. And he said, well, what's the consequence? I said, well, a C Corp has a double layer of taxation. The corporation will pay taxes, and then you personally will pay taxes when the money is distributed to you. And he said, but that's double taxation. And I said, yes, you're right, it is. So whether you're ready to sell your company today or not, Every year, you should be talking to a tax advisor to see whether or not the changes that have occurred in the code have an impact on you and how you're structured. And it is far better to make major changes to your company in the year or so before you go to market. It becomes very difficult once you're in the market and impossible to do once you have a letter of intent.
I want to mention one other possible, change or tax consideration that may result from the administration changes. There may be things in a new Biden tax plan, and I believe, there's evidence that he would look at these things in presenting a new plan. For example, for an increased emphasis on research and development. So the tax, the tax deduction for R&D may go up. Those kinds of tax planning things that will make its way into any sort of, as we saw with the 2017 changes, really will need to be taken into account, and those are potential. Also, they may not be as great as capital gains and or corporate tax rate changes that get the headline, but they could save your company lots of money, and inevitably in any kind of major tax overhaul or re-overhaul of the tax code that may occur. There will be some winners and losers and some priority areas for tax deductions, et cetera. So those are also areas to keep track of.
Jennifer, do you have other questions?
Yes. Generally, what are the valuation drivers when arriving at a price for my business?
Well, we talked about that a little bit before, but let me go into it again. Maybe we can put that slide back up, because essentially there's two really important numbers when you're thinking about selling your company. The first is, what is your EBITDA? And your EBITDA is some modification of your net income. You could look over your net income for the year, for the last 2 or 3 years, depending on what the trends are. Obviously, if your EBITDA has been increasing, that's a very good thing. If it's decreasing, not so good. So the first issue is we've got to figure out what the EBITDA is. And one of the things that we do at sbLiftOff is that we do a normalization. That is, we look for expenses that the current owner has that a new buyer would not have to have. So for instance, I had one company that just before they hired us went out and bought $250,000 worth of cars. And there were all of these leases being paid through the company. Well, it's their company. They're absolutely entitled to do so. But we backed that out because those cars were not going to be passed on to the buyer. That was not a cost that they have. So the first thing is really coming up with an EBITDA number that is based upon your financials and that is normalized to look for what a buyer is going to have to incur. The second is multiple. And that slide was talking about the multiple. For GovCon, it's anywhere between 2 and 8. Really, it tends to be between 3 and 6, 4 and 5 are very common. And the factors that go on there are, is the revenue going up or down? Where are you in your GovCon cycle? Are you basically looking at recompetes in the next year or two? Or do you have backlog that covers at least 3 years of your current revenue? Are your margins locked in? Do you have fixed firm price contracts, or do you have T&M? So there's a whole bunch of issues, clearances and things like that. So those are the 2 basic numbers. Now, having said that, there are lots of valuation methodologies. You can do a discounted cash flow of your backlog. You can do an asset valuation. But in most deals in the GovCon market, it's usually done as a multiple of your EBITDA. So really nailing down what that EBITDA is on a normalized basis, and then being able to justify what that EBITDA multiple is. So just putting a too fine a point on it, let's say you've got $3 million of EBITDA. That's great. And if I say, basically looking at everything, you can get 4 times that. Okay, 4 times 3 is 12. That's terrific. But if we think that you can get 6 times that, well, we're now 6 times 3 at 18. You've just gotten an additional $6 million for literally the same company, the same EBITDA. But it's the characterization of the company that matters. And that's, again, where an M&A advisor comes in. We tell a story about that company. Also, one of the things that we generally do is that we do not put a price on a company when we go to market, because we can tell you what the company is worth in your hands, but that company might very well be worth a lot more in a buyer's hands. So we don't know what the buyer's cost of capital is, what their strategic goals are, et cetera. We were working on a transaction about a year ago, and we thought that the deal was going to come in somewhere in the $30 million range in terms of enterprise value. And by the time that we were done, we had a buyer that was paying almost 3 times that amount because they had a strategic reason for that client that we weren't aware of. So unlike when you're selling a house and you put a stake in the ground and say, house is for sale, here's the purchase price. When you're selling a company, you can't disclose it by putting a stake in the ground, and you certainly shouldn't tell them what the price is going to be because it could be worth more to the buyer.
Absolutely agree. And to wrap up, not wrap up, but to put a finer point on what Sharon is saying here is that valuation is really in the eye of the beholder. There are obviously factors there that are all go into and everybody looks at, et cetera, but there's maybe some companies that value certain programs more than others, et cetera. But one thing I can say from both a valuation and a deal certainty perspective, auction processes where you have gone out to a number of buyers tend to result in higher valuations and more surety of closing. Obviously, sellers are presented all the time with one-off transactions. A company that they do business with, a company they know, may approach them and say, hey, we'll do this deal. You don't have to pay us, Sharon Heaton, to do the deal. And that can work, and we have seen it work. But we have often seen those processes fall apart due to sort of just misunderstandings and the fact that the process has not vetted out the issues that may drive valuation and may drive deal certainty. And so, often those are, hey, well, I get calls from out of the blue sometimes, hey, we've got an offer, we got an LOI out of the blue from XYZ company that we know. We really want to pursue this. It sounds like a good deal, et cetera. One, you don't know if it's a good deal unless you've tested the market. And two, you really got to make sure that that deal has the certainty if you're going to spend the time and the money to pursue it. So valuation, all the factors that Sharon mentioned go into it, but valuation needs to be tested, I think, is sort of my experience.
I think that's completely right. We actually worked with one company. We seem to have a bit of a specialty in companies that have gone to market before and failed and then hired us. So I'm just saying. There was one who literally had gone to market 13 times and had never been able to get it over the line. And he said, what are you guys going to do? And I said, what we're going to do is we're going to be very detailed, we're going to be very forthright, and we're going to be very honest. And we were able to close that transaction. So that works out very well. Sometimes getting a letter of intent or an indication of interest over the transom is kind of interesting and appealing, and let's be honest, it's flattering. But that might not necessarily be your best deal going forward, and it needs to be poked and prodded around a little bit to determine that.
Sharon, I have an interesting question here. What are the implications of PE firms entering the GovCon market? Should I be wary of PE as a seller?
I love this question. Saying PE, and that stands for private equity, makes it sound like there's one category of private equity. And the reality is there's as many different kinds of PE as there are colors in the rainbow. There are some PE that are primarily financial engineers. And what they're looking to do is to go into a company, jack up its revenue, cut its costs, increase its earnings for a 3 or 4 year period of time, sell it, and who cares what happens. That's almost never the kind of PE, in fact, it's never the PE that we work with. We work with PE who are very focused on, one, the founder owner. Most of our clients tend to be people who started the company or bought the company and have a real proprietary interest and concern about that company. So they care a lot, as we talked about before, of who the buyer is and what their value set is. We're finding that there are some private equity firms coming to the market who really understand GovCon. And there's some that really understand GovCon with designations. So it's not easy, but you can do a private equity deal if you're a full and open company, and there's lots of PE firms that are interested in those kind of deals. But finding private equity, or in this case, there could be searchers who are looking to do acquisitions of GovCon companies that may in fact have designations, is a growing part of the market. And it really depends upon the quality and the characteristics of that PE buyer. Are they somebody who's in it for a 3-year flip? And okay, that's one scenario, and that could be acceptable to some people. Or are they there because they see some long-term set of goals that they're looking to achieve? This acquisition will fit in with other things that they're doing, and that's when you're going to get probably a more satisfying result. So PE is a very broad category, and there are some PE that you probably going to want to deal with, and others that are truly wonderful. And the advantage of PE is that PE is in the business of buying companies. That's what they're set up to do. They're set up to do the due diligence. They're set up to deal with. They're set up to negotiate. Strategics, could be another company, aren't in the business of buying companies. So those processes often take a little bit longer, and they can be subject to changes in direction of that company. So you have a CEO, he's all gung-ho, I want to go in this direction. He leaves after 3 years. A new CEO, they want to go in a different direction. So if you were in the middle of a deal with the first CEO and he leaves, well, you might find yourself in a different situation. That's a lot less likely to happen with a PE firm. You have to make sure that you're dealing with a PE firm that shares your values and one that understands the GovCon market. Not all of them. Jonathan, what's been your experience?
I would fully echo for the first point. My first point is that you need a PE buyer that understands the GovCon market, because it's not that you're not buying a tech firm. It's a regulated industry that has interesting ways of contracting, the ways that contractors get paid, the ways that the risk on contracts, et cetera. You really need to, and the regulatory and audit risks, you need to be comfortable with all of that. And you really need to understand the market in terms of how the relationships between the providers and their customers work. Sometimes that's a nuanced relationship. Sometimes that's not always evident on paper, and it is more personal. And private equity firms that have been around the block in GovCon, and there are a number of them, they have been in the space for now 15 plus years, and in a major way. Obviously they were in partially before that with Carlisle, et cetera, but they are a major player in the market, doing up to 50% of the deals that are done in the marketplace. And many very successful, very reputable, very trustworthy private equity buyers who know the space, who have strategies and really understand what they want to buy, what they want to put together. And so whether or not that's right for you goes back to Sharon and my original point, which is what's the right time to sell? Is the right time for you? Who's the right buyer? Is a PE firm the right buyer? That depends on your goals. If you're somebody who wants to just walk away and with a lot of cash and not worry about things, a PE buyer may not be the best buyer, because their deals tend to have some back-end consideration, earnouts, seller notes. A lot of them will like the sellers to take rollover equity. And that can be a terrific opportunity for a seller to run the business a little more and get what we call a second bite at the apple, to retain some equity and work with a private equity firm to expand the business and or do some acquisitions along with a private equity firm, play that role. If that's if that's what you like, then a private equity firm may be the right buyer. I always tell, and I think a lot of advisors tell their sellers that you need to be pretty happy with the consideration that you're getting on the day of closing. And if there's lots of back-ended stuff, then you need to discount that a little bit. And private equity deals, because they leverage them, because they want to put not as much equity up front and leverage the deals on the back end, often have that back-ended consideration that you need to really look at and analyze.
Excellent point. And let me just make this point relatively quickly, which is when you close a deal, very rarely is there 100% of the purchase price paid to the seller in closing, at close. There are 4 different kinds of consideration, payment that are made. One is cash. Cash is king. That's terrific. The second is a promissory note. The buyer basically says, listen, I don't really have all the cash I need to do this. It's not contingent, but I'm going to pay you another X amount of money over the next 2 or 3 years. Okay, it's a promissory note, not contingent. Another way is rollover equity. And the advantage of rollover equity for the buyer is that it keeps the seller at the table. And the seller cares what happens to the company going forward. Now, the upside to that, and Jonathan alluded to that, it's called a second bite at the apple. We have seen companies where they sold 70% of the company in year 1, and year 6, there was a sale of the entire company, and they made as much money on that 30% rollover as they made on the first 70%, because the party that they sold it to was able to successfully grow the company, sell it, and they did extremely well. It's one of those things going back to the buyer is very nervous about what the seller knows that he's not saying. And if the seller wants to drop their keys off on the table and walk out the door, it makes the buyer very, very nervous. But if the buyer feels like, oh, the seller's in this with me, it creates the kind of trusting relationship that's important. And then the 4th kind of contingency is what's called an earnout. So it's a payment that if such and such thing happens, then we will pay you more money. And we spend a lot of time working on earnouts. And what we try and do is to make them as objective as possible. Very difficult to have earnouts based upon EBITDA, because that depends upon what the costs are for the buying that the buyer incurs. But we can do it on revenue. So if we see there's backlog and the revenue for the next year is supposed to be $20 million based upon that backlog, but it hasn't happened yet, you could strike a deal between the buyer and the seller that there's $20 million of revenue in this next year, then there'll be an additional payment. And that way the buyer is paying for what they get, but they're not paying if that in fact doesn't happen. So there are ways to strike it that are fair to both sides. I think that we're getting towards a time that we need to wrap up. Jennifer, are there any final questions that we should be considering?
We had a few questions, but we are at the end. So what I'm going to urge everyone to do is we're going to put up a slide with all of your contact information. So I want everyone to feel free to contact you with any additional questions they might have had. 2020 has been a difficult year, clearly, but it's good to hear that even if the pandemic isn't going away, neither is the GovCon M&A market. I want to thank our speakers, Sharon Heaton and Jonathan Wolcott, for an informative discussion. And to all of you who attended, if you have additional questions, again, like I said, please don't hesitate to reach out to Sharon or Jonathan. Their contact information is on the screen now. And I want to thank everyone and wish you a wonderful rest of your day.